If your portfolio looks red this week, you're not alone. Is this a crash? A dip? Should we panic?
Those are exactly the right questions, and the answer isn't the same for everyone. So let's break down what actually happened, why it happened, and what you should actually do depending on where you're at.
Because when there is a bad day, people usually panic or just freeze.
And both of those are usually the wrong move. Let's get into it. Quick disclaimer, everything in this video is for educational purposes only. It's not financial advice, and we're not financial advisors. Always do your own research before making any investment decisions.
Okay, let's start at the beginning. What actually happened?
So on June 5th, the Nasdaq dropped 4.2%, its worst single day since April 2025. The S&P 500 fell 2.6%, and the TSX closed down over 800 points. It was bad across the board.
What triggered all of this?
It started with Broadcom. They're one of the biggest AI chip companies out there. They reported their earnings, and the actual numbers were fine. Revenue was strong, but their forecast for next quarter came in at $16 billion in AI chip sales, when analysts were expecting $17.2 billion. They also didn't raise their annual guidance.
So they missed expectations.
Not their actual results, just their forecast. But in a market that's been priced for perfection, that was enough. Broadcom dropped 13%. And because everything in tech has been so interconnected around the AI trade, it pulled everything down with it. Nvidia fell 6.2%. Micron dropped over 13%. AMD fell hard. The Philadelphia Semiconductor Index, which tracks chip makers, had its worst single day since March 2020.
That is massive. Over $1 trillion gone?
1.3 trillion, just in US chip stocks alone. And then, on top of Broadcom, a stronger than expected jobs report came out.
Wait, why is a strong jobs report bad news?
It sounds completely backward, right? But here is how Wall Street looks at it. When the economy is adding lots of jobs, people have more money to spend. That keeps inflation sticky.
So the Fed will not cut interest rates.
Exactly. The market was praying for rate cuts this summer. But with the economy running this hot, the Fed has zero reason to cut rates right now. And higher rates mean borrowing money stays expensive, which puts a ton of pressure on tech companies trying to grow.
So two bad things hit at the exact same time.
Exactly. Disappointing AI chip guidance, plus rate cut hopes getting pushed back. That combo sent things down fast.
So is this a little crash or just a bad week?
Right now, it looks more like a pullback than a crash. Here's the context. The S&P 500 had been up about 10% since late February. Tech stocks had been on an absolute tear. Valuations were getting stretched. So when one piece of news disappointed, there was a lot of profit-taking happening at the same time.
So people were looking for a reason to sell.
Some were, yeah. But the actual companies are still fine. Micron's revenue surged 196% year over year in their last quarter. The stock just got pushed down by the panic.
But could it get worse?
We never know for sure. But look at the big tech companies. Amazon, Google, Microsoft, Meta. They actually stayed relatively flat or went up during the sell-off. That tells you the market still believes in AI.
So it's a tech correction, not a market meltdown.
That's the most accurate way to put it right now. Could it get worse? Sure. But based on what we know today, this reads like a healthy reset after a massive run-up, not the beginning of a 2008-style collapse.
So what should we actually do right now?
It depends on what you own and what your timeline is. Let's break it down.
What about people holding XEQT?
If you're holding a diversified all-equity ETF like XEQT, do nothing. Seriously, XEQT holds thousands of companies across Canada, the US, and internationally. One bad week for chip stocks is a tiny blip inside that fund.
Did anything actually go up on Friday?
Yes, actually. While tech was bleeding, a lot of the boring sectors like utilities and consumer staples held their ground. People still need to buy groceries and pay their power bills, even when tech stocks are crashing.
Which is exactly why we talk about XEQT.
Precisely. XEQT holds those big tech companies, but it also holds Canadian banks, utility companies, and grocery chains. Plus, it pays out its distributions quarterly, so you are getting paid 4 times a year just to hold it, even when the market is acting crazy. The people who build wealth with index funds are the ones who stay boring about it.
And what if you have cash waiting to invest?
This is exactly what long-term investors wait for. When prices drop, your regular contribution buys more units. You don't need to time the absolute bottom. Just keep buying consistently.
But what if people are scared it will drop even more?
I get why people are scared. But think about it this way. If you were planning to invest for the next 20 years, does it really matter whether you bought today or whether you waited and bought 5% lower? In 20 years, that difference is almost invisible. What matters way more is just being in the market consistently.
What about individual tech stocks that got hit hard?
This one's trickier, and honestly, it's where you really need to think for yourself. The question to ask is, has anything actually changed about why you bought it?
Can you give an example of what to look for?
Sure. Let's compare 2 different companies. Look at a giant like Microsoft. They sell actual software that millions of businesses rely on every single day. They have massive cash flow. If they drop 5%, the underlying business hasn't changed.
So a dip doesn't change the business.
Right. But now look at a small, speculative AI startup that doesn't actually make a profit yet. If you bought that stock just hoping it would double in a month, a market reset like this is a massive red flag.
You have to know what you actually own.
Exactly. If you cannot explain how a company actually makes its money, you probably shouldn't be holding its stock during a volatile week.
What is the worst thing you can do right now?
Panic sell. That's the #1 wealth-destroying move that happens every single time there's a difficult week in the market. You lock in your losses, you miss the recovery, and statistically, the recovery tends to happen faster than people expect. The investors who sold during the worst days of 2020 missed one of the biggest bull runs in history. Same pattern every time.
So basically, chip stocks took a big hit. The market had a difficult day. But it's not the end of the world. Stay calm and stay invested.
If this video helped you handle the market stress today, please hit the like button and tell us in the comments, are you buying this dip or just holding?
We also linked our full XEQT breakdown on screen.
Along with our video on quantum computing. Subscribe so you don't miss the next market update, and we will see you in the next one.